Hello, folks. This is Dave Guillory from Sheaff Investment Advisors. Remember, we're the firm that provides innovative portfolios for intelligent investors like you. So today we're going to talk about the market and about the world being basically a messy stew and what might happen in the future going forward. We have a few slides to show you. So today, as you can see, today the world is a messy stew. There is a lot of volatility. There is the market has had a big correction here just recently, and what might be ahead. So the world does seem to be boiling over. We have all of these problems that are just coming at us at once, and that has caused volatility, has caused the market to sell off some. I mean, crude oil is hitting new highs, and inflation is high, and we've got semiconductor problems, and the war in Ukraine, and China lockdowns, and all these problems. And last but not least, on the bottom corner, you got the Russians now talking about shooting nukes, and that's got a lot of people very, very nervous. So we might say, hey, you shouldn't be too awfully surprised about that. We did a video in December of 2021 where we showed that in the midterm election years, and the market was hitting a new high, near at the end of 2021, that the average midterm election year, the market goes down more than typical years. And so in the average correction in a midterm year, the market goes down 17%. In a normal year, it only goes down about 14%. So the corrections are deeper, but by the same token, the rebounds off of those corrections are bigger too. And the average correction, after the average midterm correction, market goes up 32%, which is bigger than normal. So in our December Sheaff newsletter, we painted a picture for people, and we said, look, the S&P, if we just did what rhymed with the past, if it was the normal midterm correction and normal rebound, you might see that the S&P 500 drop down to 3,900, and this little chart at the top is right from our newsletter. It's a little blurry, sorry, but it might go down to 3,900 and rebound to over 5,000. And by the same, if you use the same math, the Dow could drop to about 30,000 and then rally up to, close to 40,000. So we painted that picture. And we said, here are three things at the bottom that you need to do in 2022. Number one, expect a correction. Number two, stay invested, or better yet, add more money if there is a downturn now. And number three, when the midterm elections come along, go ahead and vote, which you should do anyway. So what might be ahead? Well, the American Association of Individual Investors, which is a group of investment club members, they've been asking the same question in a poll every week since 1987. Are you bullish, bearish, or neutral? And they've been keeping track of these numbers for years and years and years. And this is a very good, historically, it's been a very good contrarian indicator. So the bullishness now is only at 15%. That's what 3 weeks ago. 2 weeks ago, it was at 18.9% bullishness, which is a very low number. And this week, it was at 16.4. So 3 weeks in a row, we've been below the 5th percentile. Now, at the chart at the bottom red line shows the 5th percentile line, and it rarely gets down in that level. And now 15% is well below that level, and so is 18, so is 16. So we've been below. The 15%, by the way, was the lowest it's been since 1992, and the least bullish. And 3 weeks in a row, it hasn't happened since 1990. So individual investors are very, very nervous and bearish right now. Now, this has happened in the past. In a normal year, down at the bottom in green, in a normal year, the market goes up about 4.5%, let's say 5% over a 6-month period of time. And it goes up about 74% of the time. In the blue, when it's below this 5th percentile number, when the bullishness is in the 5th percentile, it's gone up double, 9.5%, almost 10% in a 6-month period, and it's gone up 88% of the time, not 75% of the time. And in the brown, in the middle, when it's in the 5th percentile and the Fed is tightening, which it is now, that hasn't happened a lot. It's only happened 18 times, but it's gone up the twice as much amount, 10% or so, and it's gone up 100% of the times. So the American Association of Independent Investors it's a very good contrarian gauge. Now, secondly, let's look at the VIX. We talk about the VIX a lot at our firm. The VIX normally is this average, the dotted line there is 19.5. Then this goes back to 1990. The VIX started in 1990 and it's averaged 19.5. When it gets above 30, which means there's a lot of volatility expectation in the next 30 days, when it gets above 30, that's typically been a very bullish sign. And it spiked above 30 in March and in February, and again just this week, last week and this week, where it's been above 30. Now, we did a study at our firm of all 8,000 trading days that the VIX has been around since 1990, and what has happened in the market. And again, the 6-month market normally goes up about 4.8%, or 1 year it goes up about 10. You can see there. During the times when the VIX is above 30, that's 9% of the trading days. It was like 700 and some odd trading days. When the VIX was above 30, the forward returns are twice or more than twice as high. It's been 6-month return has been 13%, 1 year 23%, which is interesting. The 23% number, if that happened, would put the S&P 500 at about 5,100, pretty similar to what our newsletter showed back in December. So that being said, the war is going to moderate. It might not end, but it's certainly going to moderate. China lockdowns will end. Supply chains are getting better. One other stat that's very interesting, going back to 1946, the 12 months following a midterm election from November to November, so November 22, November 23, those 12 months has never been negative for the S&P 500 since 1946. So is it messy? Yes, it's very, very messy. Is there opportunity? We think so. Thanks for joining us. That'll do it for this week. Talk to you later.